Welcome to this edition of Charting the Markets, where we're looking at Elliott Wave theory. A former accountant by profession, Ralph Nelson Elliott turned to trading later in life using his method of identifying cycles and waves within price action. The principles of what we now know as Elliott Wave were established in the 1930s, just as the wave principle. It was not until after Elliott's death was it called Elliott Wave theory. And the ideas are used by a number of successful traders these days, and someone who uses the principles in his trading is IG client Adrian Ryan, who joins us now. Adrian, welcome.
Thanks, Jeremy.
It's good to have you here in the studio. Why did you adopt Elliott Wave? What did you see in it as something that you thought this is worth knowing about?
Well, when I first started trading, I guess I was, like a lot of people, a little bit lost. I couldn't see the wood for the trees. I'm a financial analyst, a commercial financial analyst by training. So I wanted to try and get the bigger picture. And what I was seeing a lot in my trading was I wound up counter-trend trading or trading against the trend, which wasn't very good for me. So I hit on Elliott Wave theory together with charting theory as a way to see that bigger picture and to try and understand where we were in the cycle, pretty much as your introduction said.
Mm-hmm. Yeah. Behind us here is an example of one of your charts. There's a lot of identifying points along the way. Just briefly identify what you perceive to be the major points to pull out on wave theory. Sure. Of those that you use.
Sure. So basically, as you said, the markets tend to move in waves. Or phases, as I like to call them. And then if we're thinking about a bull market, it'll tend to move up in fives, waves of 5 up, 1 to 5, and then we'll see counter-trend counter-trend moves in ABCs. 3, a wave of 3.
So it's 5 up, 3 down.
5 up, 3 down in a bull market, 5 down, 3 up in a bear market, so fairly simplistic. So what you can see here, this is the S&P chart going back to 1982. I'm starting at Black Monday, which at the time was huge, but looks dwarfed right now, I guess. It was still a big percentage drop at the time. So if that's my first 1, 2 up off the, say, the 1970s, then I'm seeing an internal 1, 2, 3, 4, 5 to the wave 3. That's important because internally we see the same rules applying. Mm-hmm. Okay, so an internal wave profile of a wave 3, a large wave 3, is also 1 to 5. Okay, and so it's important to be seeing that to make sure that your wave count is correct. Because this isn't really mathematical, it's visual, it's intuitive. Right. Okay, so then at the dot-com bubble, the market collapsed quite significantly. It was a 50% retrace off the 1970s base, and it went in an ABC pattern, counter-trend, which, if you had recognized that at the time, you would have then said, right, well, we're going to get a rally. Okay, and sure enough, we did. We got a 1, 2, 3, 4, 5 rally. Now, for me, then we got another ABC down. But for me, because this C here off the credit crunch was lower than the original, the previous one, the dot-com one, I see that as one very large 1, 2, 3, 4, 5. That's the green numbers.
Yep.
Okay.
Yep.
So then we got the 1, 2, 3 or ABC down to 2009. All of the QE and ZERP, NERP and all that stuff kicked in, and we went on a massive rally. So what I see right now is another 1, 2, 3, 4, 5 question mark. Don't know, but it feels like we're bumping up against maybe the end of this phase. If we're bumping up against the end of this phase, whenever it comes, and it may still run for a year or two, we don't really know, but let's say sometime soon it turns. If it follows form, it'll drop 50 to 62% off the lows. That's my interpretation, which would take us down to the Fibonacci 30% or 50% or 62%. If, however, this is a change in trend, we might get a 1 to 5 down, which could go, I don't know how low.
How far through the 5 up or down, if you're in a bear market, do you begin to identify the basic Elliott Wave principle of those 5 moves? I mean, it's difficult, obviously, until you're presumably at least most of the way through the 4th one, almost.
Yeah, the hard part is at the beginning of a move, you don't really know what you're dealing with unless you're looking at the bigger picture. So if at the end of 2009, you were clear that you were seeing an ABC, you would know that the next rally would go at least higher than the previous high. That's all you would know at that stage. So then you would have to wait for price action to tell you what you're dealing with here. And if you drill down further into the charts, you'll start to see, in fact, let me just move down to the monthly so we get a better picture of that 2009 move. You know, at this stage here, you could have said, well, that's a 1-2,
yep.
And it might have been. But after time, you start to look at it and go, well, actually, that looks like a better 1-2. To sort of underscore your point, a lot of people thought that the 2015 top was the end. Right. There was a lot of talk at that time that this is the end. In fact, it turned out to just be a flag retrace. This is charting technique, not an Elliott Wave technique, which normally denotes around about halfway the rally. So once you see a flag and a flag breakout, you think, we're roughly halfway along this rally, if you're a chartist. We've got, at least another half to go, and that's about where we are, in fact. Yeah. On the S&P, 3,200 is about exactly double the flag. On the Dow and NASDAQ, we're already there.
Yeah, the double is the flag pole, isn't it?
That's right.
Your breakout.
Right.
So now, introducing flag poles and so forth, you're now talking about other aspects of technical analysis. So you do use other aspects of analysis that give you a better picture.
Absolutely. I only really use Elliott Wave theory to give me that roadmap, the big picture, where are we in the cycle. It can be helpful to corroborate trade entry points at the lower time frames, like 1 hour, 4 hour charts, depending on what people are using. But in this case, I'm just saying, okay, well, it looks like we're in a bull market. It looks like we've had the 3-4, so that means we're in the final phase, and that's really all I use it for. Then I'm using charting techniques like trend lines and channels and Fibonacci retraces to figure out where a counter trend rally might end and so forth.
Okay, well, let's move on to a live chart. And I know you're interested in gold and silver at the moment.
Who isn't?
Who isn't, indeed. That's a good point. Okay, kick us off on where you are in terms of a live chart to watch. Okay,
so if we look at silver, what we see is this long rally up to, I'm assuming that's a wave 5. It's such a strong wave, and that's the all-time high, so that makes sense. If I zoom in a little bit now on the move since then, what we see is, if you see the reds here, an A, B, C down to the Fibonacci 76-78% zone. This is pretty important for me because that's a sort of almost a last-ditch retrace level, which is corroborating my ABC count. Some people, especially on gold, are saying that that's just a wave A, and that the current rally is a wave B, and we're going to see a lower low. But if I look at silver, I don't see that. So I don't really sort of agree with that analysis. Also, a thing to note is that this is a so-called complex retrace. It's normally the A goes down in a 1 to 5, but here it's gone in an ABC. Same thing for the B, and then you can see for the C also an ABC, although the final C is in a 1 to 5 down. So that's just a different form of retrace, which is something to be aware of. And then after we got the turn here around about December 2015, we saw 1 to 5 up to what I'm labeling a wave 1, an ABC down very extended, also another complex retrace down to wave 2, and that put in a double bottom, which is another charting technique, right? So at this point, I'm saying, okay, well, if it rallies up, I think that's a double bottom, I think that's a retrace, and now we're onto a rally. How high will it go? Don't know yet. Let's zoom in. If we zoom into the weekly, you'll see I've got a trend line here, or triangle, drawn off a lower line, which is across the double bottom. And recently, it broke through that trend line after that complex retrace and another small retrace before it took off, okay? At this point, it seemed like everybody was saying gold is going to 5,000, silver is going to catch up and overtake and go to however high. But I've been a little bit more reticent because I'm expecting, and have been expecting, another retrace.
A deeper retracement, yeah.
Not below the lows,
right,
that some people think, but at least a retrace back. In the last couple of days, we certainly got, certainly the last couple of weeks, we got what looks like a bearish turn. And I should have said at the beginning, as a swing trader, it's important for me to identify the turns. One of the reasons I use Elliott Wave theory is to try and identify those turning points. And then I will trade accordingly, both up and down. Okay. Right. And we also have a price gap on this chart, so I'm expecting that at least it would close the price gap, unless that's a breakaway price gap. And certainly right now the price action is suggesting that we will see a further retrace, although we could see a consolidation at this stage. If I saw that sort of laterally consolidating, I would then be preparing to trade the breakout of the consolidation. But at the moment, my sort of lead hypothesis is a further retrace to some point, still to be decided.
And I guess in part it's explained by that shooting star candle on the far end.
Yeah, well, that's a very obvious example of something bearish happening in the market, and there's lots of theories, I guess, for why these things are happening. I don't worry too much about that. I just trade what I see. If then we just dive in a little bit further, what you'll see here on my daily chart is a channel, a set of parallel lines, very classic charting technique. Currently the market has been stopped around about that level. Now, one of two things for me happens here. Well, one of three really, because I guess it could shoot up. That there could be a higher high up to about 2,000, you know, to complete. Until the channel is broken, I won't really know. Equally, we could get a retrace, so we might get, you know, a sort of a small 1, 2 or AB retrace, and then it breaks a little bit later. But my lead hypothesis is that's the end of the first wave. We'll be looking for Elliott Wave number 2, and then it'll really take off. And
a break of that trend line presumably will reinforce your view that it's lower.
Completely, and so for chartists, typically trading the breakout of the trend line is a way to go. Although that's a very deep move down, so that's a lot. Your drawdown potential is a lot riskier there. So at this stage, I'd actually be almost hoping for something a little higher. So and then I would be using maybe a Fibonacci retrace to try and spot how far any sort of vertical or rally retrace might go.
You mentioned silver in comparison to gold.
Yeah.
Bring up a chart of gold and to explain what's happening there, because I think it's interesting in the context of your application of the theory to look at this market.
All right. Well, if we look at the equivalent chart on gold to silver, you can see the same rally up to 2011, but a much shallower retrace. This one only made it to the Fibonacci 50% zone, which means technically there's a lot more room sort of down for that larger ABC that some analysts are talking about. But I still see the same ABC. It could be an ABC to an A, and then, you know, as we described before, a more complex retrace. So I can't say with absolute 100% assurance that, that I'm right and they're wrong. This is the nature of these things, right? However, the silver chart suggests that it isn't going to be an ABC to me, at least. Here, though, we have a head and shoulders formation as opposed to a double bottom.
That's an inverted head and shoulders.
An inverted head and shoulders, yeah. And the same kind of breakout. Okay, now if we look at zoom in a bit on this one again and look at the weekly, what we've got here actually is a neckline for that inverted head and shoulders, and there's the breakout. So that's similar to the trend line, the triangle trend line on silver, but obviously a different form. Now in chartist theory, a neckline is often retested before a rally really gets going. Admittedly, this is quite a strong rally away from the neckline. It doesn't have to happen, and so a retest of that might not happen. But if this is a wave 1, and we've seen that top out now with almost a sort of a double pin bar drop there, a retrace to the 50% Fibonacci is fairly standard, I would say, in my experience, and that coincides with the neckline. So this is another reason why my lead hypothesis is for an ABC retrace of some form on gold to get us to about 1350 before this thing really takes off. And then in terms of fundamentals and stuff, maybe the stars are more aligned for a concerted rally.
Yes.
Okay.
Yeah.
So that's how it works.
Yeah. Well, look, it's interesting your run through of how you apply Elliott Wave. I know there's an awful lot more to Elliott Wave, and of course, other people will use different rules and regulations around the theory. But
well, the rules are kind of always the same. You know, if you sort of read the theory of Elliott Wave theory, they give you the rules. It's how people apply them might differ a little bit, and because it's not mathematical, it is very much a judgmental tool and visual tool.
Yeah.
So,
well, look, it's great having you in the studio, Adrian. It's great to meet you, and thanks indeed for joining us. That's IG client Adrian Ryan, independent technical analyst, taking a look at his application of Elliott Wave theory.